So, Rick, I just missed my flight by 14 seconds on Monday out to Vegas. I get to the airport, and she said, you can't, your bag's too big. You got to go check it. Okay, no problem. I go to the line. She says, you have 45 minutes until your flight. I said, good. My flight's at 7:30. It's 6:44. She says, no, now it's 6:45. I said, but it was just 6:44. She says, and now it's 6:45. Go downstairs. You missed your flight.
Wait, but why would you miss your flight?
How crazy is that? It's a 45-minute cutoff.
They won't check the
your
bag. They won't check the bag inside of 45 minutes.
Can you imagine? And so nasty about
same
it.
thing. It's brutal.
And
I just stay overnight in Chicago. Same thing.
I'm a reasonable person. All I wanted was, listen, I'm sorry. I know this sucks, but this is the policy. It was, and now it's 6:45. Go downstairs.
Yeah, that happened to me with my son. We went downstairs. It was Florida, so it was another flight 20 minutes later. But I mean,
now the truth.
No, if it's your last flight, or you have to get.
That's the worst feel. That's the worst feeling.
The reality is, the lounges are so good. That I had 5 hours of work to do anyway.
So you just did it.
But it's just so frustrating.
Yeah. They said to me, "You can't go." I said, I had to get back from Chicago. I said, send my bag to Phoenix. You do that anyway. So they said, no, you got to fly with your bag. I was like, I got to get back to New York. It was the last flight. I said, I got to get back. I said, you're not going anywhere. But they did the same thing, though. They ticked the minutes because the woman said, you're in first class. Why are you in first class? I said, I don't know. So she said, well, I'm not sure why you should be. So anyway, she's hitting all the numbers and went over the time frame. I said, I'm over the time because you've been playing knock hockey on the screen here.
So they said, don't worry, you'll still be in Comfort Plus. I get to the gate. What seat am I in? E29. What zone is that? Zone 8. I said, listen, I've been here for 6 hours. Can I please just board with the 4th zone, sir? Back in the line.
Yeah.
Really?
Yep.
That's fun.
They're not taking any more nonsense from you.
That was fun.
This year. All right, so we use these. You're going to be able to hear the show and yourself in the in the headphones. Now I know you don't do a lot of media, Rick. So so just hang tight. I'll guide you through it.
Okay. Does it matter which is right or left?
It says
the cable comes down on the left.
Cable comes down.
Rick, you're comfortable talking bonds?
I'm gonna try. You'd be surprised. Equities are easier.
See, Paige, we told you he'd have fun.
I mean, I could do it for him. I know
Oh, well, what is this, guys?
Hold on, Paige. Do you accompany Rick to most of his appearances?
Something we're trying out.
Okay. Did you ever hear the story about chauffeur knowledge?
No.
You've never heard this story? Do you know what I'm talking about?
No.
Okay. So there's I forget.
Who was this? Who told the
There's a famous Swedish, let's call it, physicist. And he gives lectures all over the country. And everywhere he goes, he has the same chauffeur who drives him to all of these. And then one day for fun, he says to the chauffeur, he says, let's try something different. How about today you give the talk? And nobody there knows what he looks like. So the chauffeur gets up on stage and does the entire talk flawlessly until someone in the audience asks a question.
That's awesome.
So that's...
Wait, isn't there a punchline?
That is the punchline.
No, he doesn't say, that question is so dumb, I'm going to let my chauffeur answer it.
Yeah. Right. So I'm not saying you have chauffeur knowledge, but it's not the worst thing to have.
No, Paige can definitely do it better than me.
I feel the same way about Michael. He could do my shtick if I ever lose my voice.
Thank you, Josh.
So
I like the new setup. I like it.
Oh, you got a different mic?
Yeah. What do we think?
Yeah, it's way better.
Way better.
What was it before? Like
It was
metal
like
arm?
It was yeah. Thank you, but gentlemen.
You had to pay your dues to earn that mic stand.
I feel good. I feel like I made it.
We're looking out for you, Mike.
All right.
How we looking, guys? Everything's okay?
I think we're pretty good.
Is that parade outside going to affect the show or no? All right.
Let's pod.
Yeah, let's do this. Let's do this.
You got an
It's a
important
very
man.
very important man here, guys.
Oh, yeah.
Episode 169.
Nice.
Ho, ho, ho. Merry Christmas. Lock in your yield at public.com. It is the reason for the season. You can lock in 6% or higher with a bond account at public.com. The Federal Reserve is probably going to cut this month. Maybe they'll cut next year. Maybe they'll cut as many as 3 times, which means you will earn less on your cash. Public has a solution. It's bonds, corporate bonds, treasury bonds. You can learn a lot about it by going to public.com/compound. This has been brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account to learn more. Episode 169. It's almost like it was meant to be. Ladies and gentlemen, with us today is a very special guest. His first time on the Compound and Friends, but he says he will be back once a week.
I like that.
You guys, this man is, I would say, a paragon of asset management and just market wisdom and trading expertise and analytics and everything that you could ask for in a guest. And we have been dying to have him on the show pretty much since we started. Finally got it together. Rick Rieder is BlackRock's Chief Investment Officer of Global Fixed Income and head of the Global Allocation Investment Team. He oversees roughly $2.4 trillion in assets. Before joining BlackRock in 2009, Rick Rieder was president and chief executive officer of R3 Capital Partners and was at Lehman Brothers from 1987 to 2008. And then something happened. I don't know what it was. Rick won Morningstar's 2023 Investing Excellence Outstanding Portfolio Manager Award, and he has flown commercially more than 2 million miles this year. Ladies and gentlemen, give it up for Rick Rieder.
Thanks for having me. Not this year. Not this year.
Not this year. Lifetime?
Yeah,
So
lifetime.
87 to 08, those are some bookends, huh?
That was, by the way, I started, and I thought I started at E.F. Hutton, and I thought I lost my job. We all thought we lost our job in the financial crisis. And then a couple of us got super lucky and got adopted by Lehman and went over there. But yeah, so that was a rough start, and then obviously the end was rough. But
Before we go there, I have two questions for you. Why aren't you flying private?
so by the way,
Do you know anything about this?
So I fly. I don't know. I've been flying for it's just all over Europe, just all over Asia. There are some airlines better than others, and some airlines, by the way, it's pretty nice. Some others, I've had more bad food experiences than
Name
anybody.
names.
I get in trouble. But I just flew. The one I hit 2 million miles on served me a 2 million miler meal that was heinous. And I don't know what.
All right. Shout to Emirates Air. So my second question, why don't they call you a bond king? You are. 2.4 trillion under your team. I know it's not just you. Gunlock's a bond king. Bill Gross was a former bond king.
You're a sheik. You're a bond sheik.
You're like almost a bond sultan.
I don't know that I want the title.
You don't want
usually,
it?
No,
Why not?
usually because they get overthrown. I don't know. I feel like, I've said this my whole career. Like once you think you've accomplished something, like that's when I always think like the taller you lift your head up, the better chance it's going to get taken off.
I try to tell him this. He doesn't listen.
But bond king is like it's very apropos. I mean, we're going to talk a lot about the fixed income operations that you guys oversee at BlackRock. It's substantial money, of course, but it's not just the assets under management. When you guys speak, everybody listens. And that's very bond kingish from my perspective. So
I don't know.
You don't have to have it if you don't want it. But.
Yeah, I don't think it's wisdom. I think, we run a lot of assets in the listen, I will say one thing about when we do speak. I mean, there is the amount of research and work. I do these monthly calls. I mean, I must have spent, 80, 90 hours on, it takes, because you do the same thing. The amount of research, the amount of insight.
I don't take 80 hours to start calling.
But to really know what you're talking about.
Yeah.
Like I just don't think you can wing it. I think you got to put an immense amount of time in it. So hopefully people feel like
it shows without a doubt. And when you guys put research out, everybody wants to know what you think, and it's evident that obviously the success is self-evident. But I think it's evident to people that you choose your words carefully, and you're not just doing vanilla like, oh, here's our marketing content. You have opinions. And I think that goes a long way.
Thanks. Yeah, no, we definitely listen. We try not to be. Sometimes I've learned in my career you gotta be in the consensus, and you gotta be. I mean, I always said this expression that you gotta ride the wave and you gotta get off before it crashes into the shore. And we try and be where it makes sense to be aligned with everybody else, but try and be a bit differentiated.
Yeah.
There's I have some pretty strong views about things that are quite different.
Yeah. I want to quote a profile that was written about you in Investors Business Daily. It says, data, Rieder says, is his guiding light. Downtime for him is pouring through 1,000 market charts and tables on a Saturday morning. Fun is reading big picture market research published by Wall Street's smart money crowd. His goal? Get a cohesive view of where the world is going and not get caught up in the story of the day. And you said, I just keep reading and reading and reading. It gives you the confidence to make decisions and that you're making the right call. This is like what all the great investors have in common. They're nonstop readers. Pun intended.
Yeah.
Rick Rieder. Okay.
Listen, the only thing I will say is I find, and I don't know if you agree with this, I find that the world has moved, and I don't know if it's social media, much more to a momentum, the soup of the day, this is the hot thing, and everybody's on that. And I feel like the real money is made getting deeper into the things that not everybody's focused on and understanding. Like I read a lot of documents, boring, 10K, 8K. I read, and quite frankly, like economic data, I find the published economic data, everybody gets it. It's usually revised. Like I read tons of earnings reports. Like I learn a ton from what's happening to margin, why are inventories growing, why are people hiring. The payroll report is interesting, but you've learned a lot more if you read why are companies hiring, why are they hiring in leisure, why are they not hiring in manufacturing. You get all that data from other sources. So
you're on the fixed income side, but you're reading companies' earnings reports as though like a stock analyst would.
Yeah, I just think I get way more out of that than anything else.
So how do you separate, if you're reading so much, how do you separate, because this is such a momentum-driven news cycle, how do you separate noise from signal?
It's really hard, and I would say some of it's old age, and some of it is just literally seeing so many things over time. But I also, you get to learn over time, like you all are great at. You get to learn over time there are certain CEOs that are very thoughtful or very tuned in. You see that in retailing, you see it in others. So I like to follow. There's certain ones, their commentary is interesting. I quite frankly get a lot out of, we use AI to figure out their trends in terms of verbiage and what they're saying. I read cash flow statements a lot. And I think you learn, like when we talk about a company, you hear, well, we like the momentum of this, we got this. And then you read the cash flow statement and it tells you way more than anything else you get. So I like to see what's driving, why is EBITDA what it is? What's CapEx? What are they buying back in stock, et cetera? And so
are these just for companies that you're investing in the debt side, or these are like blue chip companies that you think are emblematic of the environment for corporates in general?
So first of all, I think the world has separated into, there are huge, whether it's Mag 7, but I think you could go probably another 20, 30 companies beyond that are big cap companies that are, that are really driving CapEx, R&D, inventory build. And so I like reading many of those. So you can go beyond Mag 7 to the Walmarts, to the Exxon, to big companies that are driving so much of the ecosystem today.
Right. Can I show you a chart that I made in 2018?
Yeah.
So that's quite a while ago, right?
Yeah.
And we're having the same conversation today. So in 2018, I made this pie chart, and it shows Apple, Amazon, Alphabet, Microsoft, and Facebook were equal. These stocks were equal to the bottom 282 companies in the S&P 500. Take a guess what you think it is today. I won't put you on the spot unless you want to take a guess.
What they're equal in market cap?
So the bottom, how many stocks? So they used to be as big as the bottom 282 stocks in the S&P 500 today. We just updated this chart.
450.
Very close. 407.
Yeah.
So it was 282. And remember back in 2018, we were screaming, how is this possible? How does it? And it's gotten even more extreme.
So it's pretty extraordinary. One of the things that I think is driving it, I think companies' utilization of data is part of why, we get in this dynamic, and I've talked about it, and I don't always certainly have the right call on it, a small cap versus big cap. The companies that have the data, that can exploit the data, and it's so hard for any small business to compete. If you have the ability, I look at the big retailers, the Walmarts, the Amazons, obviously. If you know what price points are, how to drive in, what drives inventory versus what doesn't.
Who's buying what, at what time. Yeah.
It's all about the ability to utilize data. And I think that moat for those big companies keeps growing.
So does the ability of companies to have real-time data dampen the boom bust cycle that has the economy has experienced over the last forever?
So I don't, I've done this before. I don't think the U.S. economy goes in recessions. Like unless it's a pandemic or financial crisis. I actually think I call it the satellite economy.
Right, you know that we're being recorded, right?
Yes, sir. And so I know it's a crazy statement, but I have a very strong point of view that 70% of consumption in the United States is driven by services today. Service economy's only gone into recession twice in 75 years. Pandemic, financial crisis. When you have a service-oriented economy, what people spend on healthcare, education, what they spend on their phone bill, their cable, et cetera, it's incredibly constant. Unless you have some systemic shock, this whole idea of hard landing, soft landing, I just don't think it lands. And I'm not saying there's not iteration around a trend that generally is driven by the demographic, but I just don't believe in this cyclical. China's cyclical. Export, manufacturing,
That's what I was
hard
going to
asset.
say. When you understand the causes of previous recessions, it's like they raise interest rates, the banks charge more to lend money, all these industrial companies are able to borrow less, and as a result, they start hiring less people or lay people off. Those people stop buying cars and refrigerators, and then in an industrial economy, it's guaranteed. It's a recession. If we no longer have companies, public companies, that require bank funding at prevailing rates, then what are we talking about?
So also, you think about the free cash flow generation of these companies.
Yeah.
Actually, not only do they not borrow, they're long cash. And so actually, if you raise interest rates, they make more money. It's actually...
And their margins are up 30%.
Totally.
Interest expense went down. To me, that was the chart of corporate interest
Totally agree.
expense went down in 2023.
Totally agree. By the way, the other side of it, or the corollary to that, is you think about the consumer today. So who's driving consumption in the economy? It's people 65 and above.
Yeah.
They're net savers who don't have any debt.
Yeah.
So what ends up happening is the more you actually raise the interest rate, the more they've got.
So you and I knew this and both very publicly said this
Yeah.
Over a year ago.
Yeah.
I think it was you. You said something like, I'm not completely convinced that raising overnight rates is not stimulus.
Wait, and I think you said it first.
Yeah.
I might have
probably
beat
did.
you
Can I
to it,
give
but
Josh some credit because
I think
he
he's
said,
probably right.
He said this on TV with the Bond King.
Yeah.
And Jeff Gunlock,
Jeff didn't like it.
he laughed. And at the time, it sounded crazy.
That's not an original insight by me.
Who'd you steal it from?
My father-in-law is a CPA, and he got his start in the early 1980s.
Yeah.
And he said, in the early 1980s, I knew older, richer people who did not have mortgages, were not paying for college tuitions. They were past that part of their life. And the cash in their accounts was like a geyser spitting out more cash, which produced a wealth effect, which is where eventually you get lifestyles of the rich and famous. We had a boom in the early 80s for wealthy people, not for everyone, for wealthy people. I think we just experienced another version of that.
So can I throw out one other addendum to that? So you think about the housing market, and so part of why I think the interest rate tool doesn't work today or it's not effective, you look at the last CPI report, not as much in this one, but the last CPI report is shelter inflation is still sticky. If you brought the interest rate down, you'd create more velocity of housing, you'd bring down affordability, you'd build more homes. I mean, we were looking today, D.R. Horton, Toll Brothers. So you look at the dynamics, and all they talk about is you got to use margin to stimulate. Well, what if you actually brought the rate down? You get more home building, you bring inflation down. It's counterintuitive historically.
It's counterintuitive because you think we're keeping rates high to stop the inflation.
Right.
Actually, no, that's not the issue. The issue now is housing affordability and rents.
Yeah.
Bring the rates down, and maybe people will build more. It takes a long time, though. There's a lag. I want to bring you back a little bit. We're going to go a little bit into your career because I think for the listeners, one of the things they get out of the show when we bring on people like yourself who have truly succeeded in business. They want to have an idea of where it started, and they want to hear about the road. We talked to your first high school girlfriend.
I didn't have one.
So
it's like you must have done quite a bit of research.
Okay, so you took a job right out of school as a financial analyst at Chemical Bank, but then right before you start, a recruiter for E.F. Hutton offers you a fixed income trading job instead, and you spend a day on the floor at E.F. Hutton, and you got hooked by the trading. You said, I fell in love with the concept of taking risk. After sitting with several of their traders, I completely reversed course that day and decided to pursue a career in trading. Talk about that.
Wow, that's good research. That is 100% right. So, listen, my family didn't come. My parents were entrepreneurs. I didn't grow up around finance. You know, a lot of people that come in the industry.
Finance, see?
In this case, he's right.
Well, he says finance.
Nah,
you and
finance.
I
I said
yeah.
you finance a vehicle. Keep
Rick
going, Ray.
Rieder and I say finance.
yeah. I don't,
You could argue with us if you want.
But I don't. So my parents, my parents were in it. I didn't have a relative. My relatives were orthodontists and optometrists. So I don't. So I went there. I didn't know a thing. I couldn't understand a word they were saying. I didn't understand it. By the way, I didn't get a job when I was interviewing out of business school. Like E.F. Hutton thankfully hired me. There was this one person who, whatever. I played sports. I was interested in. I gambled on sports, and but I liked the competitive nature, what have you. But I wasn't offered a job other than I got this one at E.F. Hutton, other than being a strategist because I was pretty good at writing reports and. So anyway, I did it. So anyway, I took the risk, and
Where is their office in 87?
Oh my God, it was right here. It's 52nd and 6th.
Now this is 1987, so it's like Gecko times.
Yes, sir.
It's like the movie.
Yeah,
Yeah,
no,
yeah.
It was definitely right. And I remember. By the way, I remember I called my dad and I said, I'm gonna take this shot at trading. And he said, it's not a career. He said, you've got a business school degree. That's not a career.
Oh,
it's
wow.
a hobby. And I'm like, how much I still trade today? I'm like, I still am doing it. So 37 years later.
So you
I'm still
like the
doing it.
competitive nature because there was an echo to the athletic stuff.
There's a
and-
score.
okay.
Totally.
There's a scoreboard.
No, to this day, I'm an investor, but I look at my numbers every single day. And it is, you're trying to generate return every single day. And you can't really, if you have a bad day, you can't say get out of your positions. But it allows me to look at, gosh, I made a mistake here. My models are suggesting this. My correlations aren't working. But I love every day knowing exactly what happened, and you can see it quantitatively.
So you're not there long before the crash of 87 happens. How long are you in the seat at that point?
4 months.
Did they blame you for it?
He was short.
No, I didn't get that. I didn't get blamed for that. I didn't understand any of it. All I did was we sat around playing liar's poker for hoping we'd get jobs.
So Black Monday, stock market, it's a 22% crash in the Dow in a single day. Didn't really end the world in the way that the great financial crisis did, but obviously it was international headlines. But some firms stumbled, and E.F. Hutton gets absorbed into Lehman at that point?
Yeah.
Okay, so you just came with the firm?
I got lucky. I mean, there were 34 of us, and somebody was kind enough to on the mortgage business to say we should hire this person, and so I got super lucky, and I was going to trade mortgages. I ended up trading corporate bonds, just because I thought the people who were doing it were phenomenally talented, what have you, and so I ended up going there. But
so you rose through the ranks of Lehman. You start on the corporate bond desk, then they make you the head of it. Then you're the head of credit businesses. Then you're the head of global principal strategies. So now you're doing global trading. Then you're the head of the firm's credit businesses. Then they make you chairman of the corporate bond and loan capital committee, loan capital commitment committee. Then you're a member of the management committee, and then you're a member of the board of trustees for the Lehman Corporate Pension Fund. What is it about you in those years that enables you to keep getting promoted? And what was special about this? Is like Lehman's golden age. This period we're describing.
yeah, I mean, so it was a pretty cool place. I mean, obviously, the firm made mistakes, and there were real estate that was purchased, and it's disappointing because there was a quite frankly, people were. In the industry, it was a really good culture with a lot of good people, and it was very entrepreneurial in nature. The great irony that people don't realize, like when we ran, I worked in a big part of fixed income. I ran a part of fixed income, a gentleman named Bart McDade, who was incredible. I learned a ton from. But our business was built on research. And it was, I don't know if you remember, we had the Lehman Ag. So the Lehman Ag, people still call it the Lehman
It's
Ag.
the Barclays Ag now, but yes.
So
Bloomberg
Ag now.
Yeah.
And so
Did you guys invent? I was told that was invented to sell bonds.
So I will tell you one thing about Lehman Ag, which is literally, and I was thankful that I started there. Like our whole business was built on research. We were ranked number one in research for many straight years, but it was all about research and how do you beat an index. And so because we had the Lehman Ag, so much of our business was working with clients and advising them around this makes sense. The index has too much duration here, or what have you, and it's been a huge help today. But anyway, it's a good culture. It was entrepreneurial, and
Sorry to cut in. Was the index built to be beat?
I don't know.
Tell
how
the
it was
truth.
built. I mean, it was built to be a benchmark, but listen, I still think today. It's.
Were you
know,
Water
there-
Street or Madison Avenue?
Where did I work?
Which Lehman branch?
I was down at the World Financial Center.
Oh, okay.
Yeah.
All right.
Because Rick, the bond guys have a lot better time with their benchmark than the equity guys do with theirs.
I mean, one man's opinion. I think the bond benchmarks are much easier to beat because there are so many inefficiencies. Too much credit, too much duration in the long end of the yield curve. There's a lot of assets that trade at very tight spreads. Listen, I think it's a lot easier. S&P 500 is a pretty hard index to beat, particularly when you've got 7 companies that drive so much return. I also have 68,000 securities in fixed income. They're not enough stocks.
Yeah, there's
And,
3,000 stocks.
So
Right.
as a bond,
But even the ones that, I mean, better than anybody in the world, the ones that trade are the ones that have real market cap.
Yeah.
So it's, it's easier to beat, I think, a fixed income
so
index.
as a bond guy, how much attention do you pay to the stock market?
A ton. I mean, I run our Global Allocation Fund, which is an equity fund, and it's a big fund. So I spend a ton of time in the equity market, and quite frankly, it helps me a huge amount in terms of looking at credit and looking at different companies. We talked about economic trends, regime identification. So, and I trade a tremendous amount of equity volatility. Like I think the options market is the most inefficient market in the world, and I manage a ton of my volatility, my beta using the options market. So I spend a ton in equities.
Do you think that because you were at Lehman and it wasn't quite J.P. Morgan or Goldman, you had more large opportunities and more ability to be promoted up? Did that help you? I wouldn't
Well-
say they were second tier. I would just say they weren't Goldman.
So I would
does that
say
help?
I interviewed with all those other places. Nobody offered me a job, so I didn't really have a choice to make anyway. So,
Okay.
but I don't know. I will say one thing I've learned over the years. Like I got really lucky because the culture was so good, and I got I would say there was always this sense of we're the underdog,
Yeah.
and there was
Bear
always
Stearns had that too.
yeah, and it was a sense of we had to work harder, we had to provide more research, we had to more and. Quite frankly, we couldn't compete based on tightest bid-ask spread, and so we had to compete based on insight and analysis. And we had a great culture. I mean, I've worked with people that I have now at BlackRock, a bunch of people have been with me for over 30 years. It's
Wow.
unbelievable. But it's testimony. It was a good culture with a lot of good people. Listen, every firm has people that are not as good as others, but we had a lot of good people that allowed you to.
So when it all goes down the tubes, you spin your own group out and you call it R3 Partners. And this is right before BlackRock.
What was R3? What
Is it Robert Griffith III?
No, so
Okay.
people think it's my initials. It's not. It is. So actually, I'm a big believer in urban education. I chair the board of for 20 years now. Our charter schools in Newark, and I do big programs in Atlanta. It stands for reading, writing, and arithmetic.
Oh, okay.
So the
Three
idea,
Rs.
yeah. So our charter was that I think it was 15% or 20% of our top line was going to urban education.
Top line. That's amazing.
Wow.
Yeah. So that was sort of that was the idea.
So
So-
then BlackRock calls, and then we get to
Well-
where we are now.
So we had a tough time in 08, and
Why? What happened?
So we were,
Well, they're giving 20% of the money away.
Yeah, well, so we didn't have any money to give away at the end. So, obviously we were a credit hedge fund. It wasn't exactly the perfect time to spin.
Oh, so you were like a 2 and 20 shop in the bond
so
market?
this is So this is May. So we spun out May 08.
Okay.
Crisis obviously hit. So
Yikes.
it wasn't like I had any prescience about the financial crisis or leaving Lehman because I certainly wouldn't have started a hedge fund at that time.
Right.
But we had a tough 08, and then we started really well in 09. And then, we had a tough call, but I think, working at BlackRock, and we thought at the time this is a place that could be one of the epicenters of finance. We certainly had no idea.
Oh, you brought the crew in with you.
I brought 42 people
That's incredible.
to
Look at
BlackRock.
you.
And so
You probably
a bunch
saved
of-
a lot of these people, frankly.
So it was a good, the firm BlackRock was really good about, these people have been with me for 20 years. And so, a bunch of them, so to this day, I'm super proud of. I think we have 25 people that are still, including running a lot of businesses. So I'm pumped about that.
That's an incredible story. So before we get to the story of today and what's going on in your world, I'm curious. You must be thrilled to not have to invest billions of dollars in a world with trillions of dollars of negative yielding bonds.
So I don't understand negative interest rates. I think it's the craziest. I don't understand why. It doesn't create, I get crazy when people talk about negative interest rates. The fact that, you think about how much of the last decade were spent negative interest rates doesn't create any velocity. It destroys your pension system. It destroys your banking system. It doesn't create the impact you want. And I've always said, so you think about a normal capital structure. If the debt people are going to get paid negative interest rates and the equity people require a return on equity of 12 to 14%, everybody will sign up for the equity. Nobody signs up for the debt. So what happens is actually you increase the cost of capital. It doesn't work. Like aggressive monetary policy, same thing that we were talking about. Once you get interest rates out of a zone of, we could argue 0 to 4%, it doesn't help to be at 5.5%.
And it's not stimulative.
And it's not stimulative.
At all. And that was the original intent, is let's support the economy with low rates. How low's too low? Who cares? Take them negative. No, it doesn't work that way. I think it destroys velocity. And you look at the European bank stocks over that period of time and how much capital was destroyed. And think about pension insurance company. It doesn't stimulate investment.
So we know Ever's a long time. You think we'll ever see that again?
Never.
It's a failed experiment. Why would we rerun it?
But it would be 0 should be the lower bound. And then, by the way, QE works, like providing liquidity to the system, creating gearing in the system, creating more velocity. That works. But
the main offenders, look at Japan. They have rising yields and a 33-year record high in the stock market.
I agree.
That should be the takeaway. I
hope
hope
that's right
for everyone else watching.
I think that's right.
Okay.
I think that's right. I think monetary policy can only do so much. I mean, the way monetary policy was supposed to work is it's supposed to work with fiscal. There's a time, and you talk about the housing market, like what would drive the housing market? It's not interest rate doesn't do a lot. If you did subsidies, if you created incentives, if you created home builder incentives, that stuff works. But, to the detriment of society, the central banks have had to carry the load entirely because the fiscal hasn't worked.
So the road between negative interest rates and where we are today, we had been telling clients for years, if you want to get some income from your fixed income, we need the interest rates to go up. Correct. We need to take one step back to take 2 steps forward. Unfortunately, it didn't work out that way. We took like 19 steps backwards.
Yes.
So what was 22 like for you?
22 is painful, I think, for everybody. And, because what ends up happening in those environments, so I said painful.
How much was the ag down? 17% to end the year?
I thought it was
13.
I thought it was 15.5.
And treasuries were down more than junk bonds.
So, by the way,
wild.
That was and so if you think about what is the normal hedging and how do you manage the risk, we ran. I think while it was painful in terms of negative return, I think we did it. Our funds did okay. It's always hard telling clients, we outperformed by 800 basis points. Like, great, you're negative. Thanks for helping.
How much did you lose, though?
Yeah, exactly. Thanks for helping. But it's, so what happens is your hedges go away. The only thing you use as a hedge is cash. So what we ended up doing is we got lucky. We built a ton of cash into the portfolio. But it's, I'm a big believer. Like the reason why I think now's nirvana, like all of a sudden equity vol goes to like, including today, buying equity vol at 8.5, and you can run an equity portfolio. You can manage your beta. You can trade around. You don't need the market to move much to move your deltas around, to move your exposure around. When volatility spikes, and then you get everything moving together in correlations.
Bonds and stocks selling off together.
But it's just cash.
This is a dangerous thing to say, but it does feel like today, it won't last forever. It does feel like a golden age of investing.
Yeah. It's like I never want to say that.
I know.
So I think there is, by the way, part of why that is, because I love vol when it's this low because you can really do a lot of things. The other thing is, listen, I think technology and the change and innovation and like, boy, oh boy, the next 2-3 years could be really different than we are today. And, let alone political change, let alone there's some really cool things to think about and invest around and knowing you're not going to get them all right.
I want to get into some of your economic takes because we've had a bunch of data in the last 2 weeks, as we always do. You reacted to the December 6th employment report. You said, broadly speaking, we think labor markets remain solid, but this month's strong non-farm payroll gains of 227,000 jobs in November largely represented a reversal of the hurricane and labor strike effects of prior months, which subsequently boosted hiring last month. And then, it's not accelerating or anything like that. It's a little bit of a reversal. We got a higher than expected unemployment number today, but I think the shifts are so minor relative to the bigger picture, which is that for most people, if they want to work, they can work. There are still wage gains all over the economy. They're moderating somewhat. JOLTS is moderating. You don't have as many people quitting. It's a super conducive environment for now for both employers and employees. It feels more balanced today than it has in a long time. What do you think about that?
I agree with everything you said. So actually, if you look at the beverage curve, you're actually at a place where you look at vacancies to the unemployment rate. It's actually at the perfect spot.
Yeah.
But there are some, I mean, there was massive hiring, leisure, hospitality, nurses, teachers, healthcare, education, unbelievable amount. Some of it was post-COVID. You had this incredible need. Now it's much more normalized. You're not seeing that significant pressure on wages. We're going from maybe an overheating labor market to something that is just normalized. There's some parts of it. By the way, if you look at hires, job hiring, it's definitely come off a lot. You look at temporary hiring,
But normalized.
Normalized.
Well, remember that
Totally.
the chart that the biggest theme of 2021 was the best way to get a raise is to leave your job,
That's right.
right? And
That's
that
right.
environment, thank goodness, is well past.
Yeah, there's something really interesting where companies are holding on to workers. And so what you're seeing is
Warehousing, they call it.
Totally.
Yeah.
And I think that's right. But like I say, I think that's pretty healthy. And then you don't see as much transitional labor.
The CFO calls down and says, "Hey, we need you to cut 20 people." And the phone call in return is, you know what? Actually, I really can only cut 15. These 5, if I let them go now, I'll never be able to replace them. I can't find another one. And that's the warehousing effect. And it's good for labor.
I think so. The other thing that's, immigration, and where does immigration go? There's a lot of, particularly in tech companies and otherwise, if you lose people and you think about, like, can you bring them back? There's a lot of issues around green card and otherwise. So I think it's a pretty healthy labor market. And, quite frankly, it allows the Fed, the fact that it is softening somewhat, allows the Fed to get the rate to where they need to get it to.
We got another CPI print today, or was it yesterday?
Yesterday.
And today was PPI? Okay. These are your, you said the Federal Reserve can feel largely pleased with the progress made on lowering high levels of inflation. There's progress, but it may remain stubbornly sticky near current levels for a time. I think a lot of people are saying the report that we just got cements the December cut, but then maybe lessens the amount of cuts we'll get next year. Our friend Neil Dutta is saying now it's probably 3 cuts next year and December locked in. You said, indeed, headline CPI increased 0.31% month over month, greater than its gains from last month, as both food and energy prices gained. That resulted in headline CPI rising from to 275 from 260 on a year-over-year basis amid unfavorable base effects. The market didn't really seem to react too much to this, though. I think the yield trade is maybe like dividend stocks came in. Here's the Fed funds expectations as a result of the report. So
I'd say a couple of things. One, listen, I think inflation coming down is over. Like, I think we have seen
shelter is still coming down.
Wait, what do you mean it's
shelter is
over?
coming. So we got this tremendous impact from goods inflation coming down. So you had what was functionally deflation from goods for a long period of time after COVID, logistics, et cetera. We don't think you're going to get anything real benefit from goods inflation going forward. I agree with shelters coming down. But now we're entering this period of, which is hard to predict, tariffs, deglobalization, what does strategic decoupling mean globally, that maybe you're going to get a bit more inflation into it. And I just don't think you can count on much. So we have inflation generally, when we model it, about being here. So we could do core
we're
PCE.
stuck at 3.3 for like the last 6 months.
Sorry, I would say the run rate, core PCE, 2.3 to 2.5 in that zone. We don't think it can come down of any significance from there. And maybe you drift up a little bit.
But
Again,
why can't it
depending
come down?
So my core CPI is like still over 3.
Is it
Correct,
the,
correct.
the
That's
service,
correct.
the services part?
So there's 2 parts of that. One, because you've got this big benefit from goods, that's probably you're not going to see going forward. And 2, it is so hard to get service level inflation with the demand for services. It's so hard to get it significantly lower from here. And then you build into it the near-term effect from what's going to happen to potentially the tariffs, et cetera. So, by the way, I don't think you're going to see a spike in inflation of any significance, but I just think the improvement, part of why I don't think anybody's going to make any real money on interest rates next year. I think it'll be on income.
You mean on a real basis?
On a real basis. I think real rates, so where you can buy fixed income today at 6.5 yield, is pretty attractive, even if inflation runs 2.5.
Real
2
rates,
and
though, it's
3/4.
like half of that. the return.
Correct.
Yeah.
Correct.
So you just have to get accustomed to that's the new situation.
Correct.
Okay.
So where does the Fed fit into how you think about markets today? Obviously, they were front and center for the last couple of years, but
So, I mean, I agree with what you were saying that, listen, I think they got to go in December. And I've said for a long time, get the funds rate to 4, get it to 4. You're killing lower income people. We talked about the housing market. Get it to 4 and then look around to see where you are. You're going to get pretty darn close to 4. I'm just not sure. I think they're going to sit back and watch the data from here, see what policy looks like, see what growth. If you take the phenomena today, we're going to print this year nominal GDP of 5 again, pretty close to
Not
5
bad.
again. It's pretty good. You could see a dynamic next year where we grow real 2, 2.5, inflation runs 2, 2.5, and then you got financial conditions arguably as easy as they've ever been. For the Fed to ease aggressively into that, pretty hard.
So Josh and I were discussing last night Jerome Powell's legacy. What do you think?
That's a long discussion.
Paige, please leave the room.
I think that's a long discussion. I think the
No,
Fed.
hit
Wait,
this-
let him speak.
Well, hold on. I want to hear your response, but let's be clear.
We were not disagreeing.
I said, as a student of history, Powell would not himself give himself an A. You would have to agree with that.
Yes. I would.
Okay. All right. Now I want to hear what you have to say.
So first of all, I think it's a hard job, and so I'd give some credit to that. I think they did a spectacular job at COVID, and I think they waited way too long on the QE dynamic and starting to move the rate up. I think that created more inflation. That created excess in the system they shouldn't have had.
So way too late to identify that they need to raise rates. What
Yeah,
about
so-
on the other side?
So then I think quite frankly, I think they've been slow to get them back down. And I think, per the comments we talked about, sitting at a 5 3/8 funds rate for that long, it was creating no good. And you were creating arguably more stimulus. So I think
Creating
that
more
was-
millionaires.
So Rick,
Yeah,
it sounds
so-
like.
So can I say one
please.
thing that I think is really important? Listen, I think it's a hard job. I agree with you. I think they did a great job during COVID.
So do I.
And so, now I think they're managing it. They're doing an okay job managing. I think they're going to take the sidelines. I think there's a lot of credit given for who made the U.S. economy into what it has been, what it's showing today. And I just think
Consumers, it's us.
that's what I think. And by the way, there's still a ton of fiscal that's still coursing its way because it's massive transfer.
Well, that's what I want to ask you. Powell comes into the job with Trump in 2017, and he's in an environment where Congress can't agree to do anything, and nobody has a big majority. And so it's just gridlock on the fiscal side. And then something changes during the pandemic where all of a sudden there's huge fiscal action. A Fed chair has to understand that the backdrop is now different. Everything in the post-financial crisis was on the Fed's back because fiscal couldn't agree if it was Monday or Tuesday.
Yes, agree.
Okay? This is not the environment anymore.
Agree.
So in the pandemic, everyone agreed the government, the Treasury, Trump is going to do things that historically only Democrats did, almost like a New Deal spun up overnight. The Fed has to factor that in to what they're doing on their side. They did not.
They did not.
And then Biden comes in and he has, it's not a mandate, but he has the ability to pass a massive infrastructure package. The Fed has to say, okay, I can't talk them out of doing that. What I can do on my end is maybe make it less easy credit, easy money. Maybe I could shrink my balance sheet faster. He does not do that either.
Maybe stop buying mortgage bonds.
And they have this whites of their eyes mentality where they want to wait till it's 11:59, and it's I think when there's fiscal action to the extent, and wait till you see what Trump does on the fiscal side. He's got both houses of Congress. He has a Supreme Court. He can do whatever he wants. So I think that's the Fed chair's job, not to interfere with fiscal, to recalibrate based on like what's happening. And so that's like my critique of the Fed. It's like, dude, are you not listening to what they're saying they're about to do?
So I would say one thing. One, you have to give the Fed has been the only engine, like you say,
Yes,
for a long
for
time.
too
So
long.
that's a hard thing, and I think too much is on their back. I think 50 years from now, though, people will look back and say the U.S. economy, no matter what you did, it would be pretty hard to hurt. You have energy independence, you have extraordinary innovation, technology, pretty good demographic, immigration, U.S. economy, bad policy has a hard time hurting it.
They tried to crash
I
the
like
car
that.
and they
I like-
couldn't.
Yeah, they,
I think that's right.
they
I
said
think that's right.
recession. They said recession may be necessary.
And we
like
said-
multiple people.
We said, "Oh yeah, watch this."
No, I think in history will go down as like a pretty extraordinary. And you think about it, it's the only one in the world that really has all those tools. That's pretty incredible. You watch Europe today,
yeah.
and I just spent the last week in Europe, and they're going to go down the path of austerity to bring the debt down. It's like,
Have they learned nothing?
it's unbelievable. It's like what Trump will do, and I think what this administration will do is, and we have a debt problem in the United States. But if we can the only way to really get it, you got to outrun it, and you got to grow your way out.
I just
from
heard
under it.
Jeff Bezos say that on stage last week.
Is that right?
seems to be the consensus
He's a
now.
smart guy.
Let's focus more on outgrowing the debt versus austerity programs. And Trump doesn't do austerity, so I think it's obvious that that's the direction we're going to go.
Austerity has no velocity to it. So when you think about if you grow, and I always say if you put money into things like infrastructure, you build ports, chip factories, et cetera, you put people to work, the vendors end up, it's got a durable tail to it that austerity does not.
Let's talk fixed income
All right.
and private credit and all the things that are hot in the street right now. You said we are underweight long-term U.S. Treasuries on both a tactical and strategic horizon. You also said combining public and private credit.
No. The CFO said this.
Oh, BlackRock said this. Sorry.
This is Martin Small.
I don't know if you have lunch with him. Combining public and private credit is the future of fixed income. In those two statements, I think there's a lot to unpack. Why don't we start with the underweight long-term bonds? You think there's a lot of risk there, or just you're not getting paid for the amount of risk you're taking?
I mean, if you're a life insurance company and pension fund, I get why you have to own it. If
Sure.
you're not, I don't know why. You've got a pretty flat yield curve. The volatility in the back end of the yield curve. So there's two forms of long-durated assets in the public markets: equities and long bonds. Equities create 18% return on equity. Your book value goes up. Bonds, you create nothing off of inflation, and it's not a hedge. It doesn't hedge your equity portfolio. If inflation is higher, your bonds are going to get killed like 2022.
The TLT hedge was not.
It's not a hedge.
Was not helpful.
No,
in that
no.
environment.
And so I don't really understand if I get all the yield I need in the front to the belly of the yield curve, and the biggest risk. And people say I get all the time, what keeps you up at night? Listen, I mean, these auctions, we had a 30-year auction. Every auction that goes by, I'm like, whew, we got through another one. We're issuing on average almost $600 billion a week of treasuries. The total debt of Australia is $600 billion. The total Mexico $700 billion. There's some weeks we're getting $700 billion a week.
But
So
isn't
you're
this where,
relieved
this
to
is where
see
the
people show
stimulus?
up.
But is this part of where the stimulus is coming? Because we're paying ourselves. Are we not the
Yes.
biggh buyers
It
of
is-
our own treasuries right now?
Well, we better be because China's selling them and Japan's not buying them. Point being, the U.S. households are buying the debt. We've got to keep showing up for the debt, and it's the biggest risk that we have today is that you're going to have auctions that people don't show up for the
This
auctions.
is the bond vigilante risk.
Yeah, and I think
Okay.
and by the way, I don't think it's your base case, but I think there is a tail risk that, by the way, I'm going to sit in the long end of the yield curve, and if I'm wrong and rates move up 50, 100 basis points, I'm going to lose 10, 15 points.
But if you're worried about that, what do you do? Because that seems to me like a we're all in big trouble.
A meteor.
Right.
Yeah.
So I think there's only one thing to do is like playing in that part of the yield curve. It's like somebody else can have that fun. It's not worth it. Just hold the front end of the yield curve, buy a lot of assets in the front to the belly, and then manage your equity. Like I always, I learned, I think it was from Kamansky, and who said this years ago. It's like the best hedge is to own less of the asset you're trying to hedge. It's exactly
Josh always
right.
says that.
That's my.
Is that right?
My hedge is like, if you're worried about it, own less.
That's what
Just
I think.
don't. Just have cash instead.
That's what I
What
think. Or it's like
what
now.
what are we hedging it for? Just sell some.
Yeah, now, or like if you're long equities, you can use the vol market. So it's a much better hedge because it's a direct relationship as opposed to something that I hope works.
Okay. I want to talk about private market assets because in wealth management in our world, this is now all the rage.
Mhm.
We're like the last category. We're the final frontier for private equity, private credit. They've discovered wealth management is a really fertile field for raising money, bringing products. I think it makes sense when you think about just how much money there is. Like there's a limit to how much investors can do in public markets, especially you talk about an S&P at 22 times earnings, Should we take it up to 25 or should we look at something else?
Mhm.
Okay. So I understand the popularity of it. I also understand that a lot of asset managers need to replace actively managed stock mutual funds,
Mhm.
which people will no longer pay for.
Mhm.
Private assets, they will pay for management of because they can't do it themselves. How do you see this ecosystem developing? Are you surprised at all by it? Do you think it goes much further next year? Have we hit a moment?
So, I do a lot in my funds. I have a bucket that I can do private. So in my unconstrained fixed income, I could do up to 15% less liquid, bespoke financing. I will say today, the ability to provide financing in real estate, in bilateral credit, the terms you get. So when people say it's a bubble, if you're lending and you're getting collateral, low LTVs, cash flow sweeps, the terms you get today are outstanding to the point that you can get 10 to 12 to 14% IRRs.
Yeah.
That's pretty darn good.
And what you're giving up in exchange is illiquidity, which everyone understands.
Yes, but if I know my IRR, and it's different, think about the growth of venture or SPACs or what have you, that's speculative cash flow. As long as you're buttoned up in terms of, gosh, I know what my LTV is, I know what my collateral is, hard for it to blow up. What I think happens is the opportunity set becomes de minimis over time
because everyone's investing in the same place.
And by the way, I also think the banking system will deregulate to some extent. So
They're coming.
So what I think happens is the companies that are, really good at privates will continue to grow. I think the merger of public and private is real, particularly in the credit markets. And so I think that will be a
this
trend.
becomes like a sleeve for not just family offices,
Yes.
but now for regular wealth management. It's maybe not a huge sleeve. I know the expectations on the private market side is everyone will get to about 20%, which is where institutions are.
Mhm.
Let's say it gets to 10. That's still huge growth from here.
So you guys have a chart from Preqin, who you acquired earlier in the year, and it's showing the rise of private markets from private equity to real estate to venture capital infrastructure and private debt, which, as Josh mentioned, is all the rage these days. And Rick, you mentioned a 12 to 14% IRR, which is the target, but at least for today, I'm sure it's a moving target, and no guarantees. And there's a compliance person probably having a heart attack. But
$22 trillion in private market assets.
It's a big opportunity.
now.
So I guess the question that I would have is, at what point do those returns become unsustainable from the point of view of the borrower? How are they able to deliver that sort of rate of return back to the lender of capital?
So it's a great question. So by the way, the thing that's really cool about that chart as well, if you take private equity and the years of growth of private equity as a percentage of the public equity market, and you look at where private credit is, a percentage of the public credit markets, the runway for private credit
Massive.
is probably 2 to 3 times bigger.
Wow.
Than so that
Just to
is
catch up.
Yeah.
just to catch up. And so I know I do think that will manifest itself. Your point is well taken. The reason why private equity is so hard today, if you're getting 12% IRR or 12% lending, you got to get on the equity. You got to get 20% plus to make the equity worthwhile.
So how does
So
the
do you-
math?
Right. So do you run out of opportunity in real estate today? Given we could talk about different areas of whether it's data center, logistics, some parts of multifamily, hotel, hospitality. You still got to have IRRs on the equity that are really good. But your point is well taken that you'll run out of the ability to be on the equity side to create equity.
I want to spend the time that we have remaining on BINC, which is your active ETF. It's called the iShares Flexible Income Active ETF, and it's BINC or BINC. How do you refer to it?
BINC.
So it's not like
BINC,
BCred or B. It's like
No.
it's all right. BINC.
Wrong company.
Okay. When did you guys launch this, and what are you trying to accomplish with the flexible income active ETF?
So we launched it in May of last year, May of 23. The
Still
idea
has
is,
that new ETF smell.
yes.
Okay.
So, but it's grown. I mean, we're about $7 billion now.
Now, has
It's-
BlackRock ever done any ETFs before this one?
No,
or-
it's the first one ever.
Okay.
So so we've tried. So I mean, the cool thing we talked about the bond indices.
Yeah.
The neat thing about this is we're creating 6 to 6.5% yield and diversifying it around the world. And why I personally and why fixed income is really hard to do. figuring out I'm going to buy a single A tranche of a CLO from this manager. The attachment points here, the collaterals here is too hard. We've got teams around the world that do it. You can diversify it like crazy. So BINC today is a high BBB rated, 2.5-year duration. So we're not taking interest rate exposure of any significance. And we're diversifying it. So what happens when you get drawdowns, rates move higher. We don't really draw down that much. High yield
Because
comes
because the maturities are so near term.
correct.
Okay.
And then, so what we're doing is just we're providing a product that's stable with a lot of yield. The beauty of it, and I think why it's getting into all these models today, is it's stable yield. And if you marry it to equity, particularly to high velocity equity, you create what is, the right amount of growth potential with income, and you keep your volatility in a reasonable.
Flexible meaning you can change your posture on where you want to take risk, or you can change how much corporate, how much sovereign. You can make all those decisions.
But what the core of what we're doing is we're trying to provide yield above an index. So about 150 off of.
So you're targeting the yield, and then the holdings will flow from that decision.
Correct.
Okay.
Correct. And so, there are times we're going to use more liquidity and use agency mortgages, and then try and keep that yield up, but then manage the risk around it.
Can I tell you something amazing? Like, what a world we live in. Somebody that wants to have fixed income in their portfolio could have literally Rick Rieder managing the portfolio. No, because in another era, this might have been like something only available in a hedge fund structure or only available as an SMA with $1 million minimum. This is an ETF.
Yeah,
Like a dentist could wake up tomorrow and buy this in a Robinhood account.
I mean, the neat thing about the growth of ETF and why active ETFs will keep growing. One, we talk about fixed income. I think most managers over time, I think it's some crazy number, outperform the benchmark over time.
Thanks to you.
I don't know about thanks to me. I think all managers in fixed income, in aggregate. But it's because the index, A, is inefficient, and B, there's so much yield available in different parts of the world.
Yeah.
I'm buying European credit. I like buying credit in Europe. I like buying equities in the US. Like, can you optimize where you have your fixed income and then to be able to buy it and sell it constantly?
So let me give you some laudatory facts about BINC. Named one of the best new ETFs of 2023 by Morningstar. Was the top active ETF flow gatherer in the third quarter of 2024. You guys took in $2.2 billion in 90 days. The fund has amassed $6.7 billion in AUM since launch in May of 2023. For an active product, equity or fixed income, that's a pretty big launch.
Yeah,
That's like a pretty big year and a half.
Yeah, but
So-
not because of, our returns are good. They're consistent.
Well,
and
sure.
They're equities up 28% is pretty good.
Not
We're
a
trying-
bad environment. And to that
No.
point, let me ask you: Are you at all concerned about how tight credit spreads are? About how consensus the good times ahead are? Like, there is nothing that's not priced for the good times to remain.
Yes, sir. So and funny, my presentation today, I do these monthly calls, and it was talking about how to get comfortable with being uncomfortable because multiples are high, like Josh was saying. In equities, spreads are super tight. They're
Cap
pretty close
rates
to
in real
historic-
estate. It
cap
all
rates.
rhymes.
Where's the value?
It all
So-
rhymes.
Right. So my whole presentation today was I think 2025 is all going to be about compounding. Like, are you compounding in the right places? Meaning, I think equities can get you 15 next year without a lot of, if you think the economy is growing at nominal GDP of 4.5-ish, like, I don't think it's that hard to get 15 in equity, but compound in the right parts of equity. Where are you going to get, tech? We talk about financials and some other places. And then, can I in fixed income? The yields are super attractive. The spreads are not. But companies aren't going to default because they term their debt out. So it's like, can you diversify it and just compound? If I can compound a 6.5, and I get 15 in equity, can I finish the year with a blended return of 8 or 9? It's pretty good. It's not going to be as good as 23, 24, but it doesn't stink with inflation running at, just under 3.
I know we're almost done, and I'm curious to ask you this, and you can punt if it's not for you. With private credit, there's all these payment in kinds going on. And back in the day, and you can explain this better than I can, back in the day, the way that these loans used to work is the bank would make them and syndicate them and distribute them, and it was every man for himself, and every man and woman for themselves in terms of if something went bad, then take it to court or good luck finding somebody to take it off your hands. Today, it's one of your competitors or you making the loan, and you're able to work directly with the company if there is any distress, and you're able to term it out or do a payment in kinds or whatever. Is that good? Is it too much payment in kind? Like where
for
do
the
you?
listener, the payment in kind is we don't have the cash to make this quarterly interest payment. We're just gonna give you more of the debt, and we'll stack it on top. And it's almost like a restaurant owes money.
That's it. It's an IOU. It's better than
now
cash.
you own more of the
So
restaurant.
I'm sure it's not black or white, but where do you come down on this?
So there's certain things that are barometers of, gosh, your eyes have to be a little more open. The growth of payment in kind is one of those things you got to be. And, quite frankly, you see a lot of deals that come to market and then all of a sudden they get oversubscribed and nobody's doing the work. Nobody's reading a document. So
no, they have money to burn. And if they don't put it to work, they have to return it.
So some of those things make me a bit nervous. And valuations, like you said, make me a bit nervous. The one thing gives me some comfort today is, like you were saying, the growth of private credit. You're able to restructure, and there's so much money to restructure. So you won't see a lot of defaults. You'll see a lot of restructured transactions, and because you can monetize the assets effectively, you can gear the
Am
assets.
I crazy in saying that's not a terrible thing?
I think it's a good thing because it's hedge funds. Let them work it. This is not
Right.
pension fund money.
Right.
This is Ares and Apollo.
Yeah, so maybe,
they could afford
maybe
it.
returns come down, but it's not defaulting because
Yeah.
No, it's not. And we talked about, as long as you believe, if you were in a very cyclical economy that was subject to some significant swings, that would be different. By the way, you think about, how much risk you want to take in emerging markets when you've got, it's pretty hard to do some of these things. So today, public markets, developed markets, U.S., pretty good place to do that financing today. And you feel pretty good about the durability of it.
Rick, did you have fun on the show today?
Yeah, it was a lot. Is
All
that
right.
it?
I had to Nope. I had to promise like 10 different people at BlackRock that you would have a good time on the show.
No,
so,
that was
all
awesome.
right. I want to get that on the record. We always end the show. I wanted to ask you what you do for fun, by the way. When you're not reading thousands of pieces of research on a Saturday morning, what does Rick Rieder do?
I have like a very simple, boring life. I mean, I enjoy what I do, so I work a lot.
I think you're not looking to travel more. It sounds
No,
like.
definitely not traveling more. So anyway, I spend a lot of time with friends and family. I mean, I'm a crazy music person. I listen to tons and tons of music. I
Did
love
you
going
watch
to
the Yacht
concerts.
Rock documentary on Max?
one?
There's a Yacht Rock
I have not
documentary on
seen it.
Max.
Really? I
you'd
will
be
watch
into
it.
that.
A lot of
I will
fun.
watch it. So I'm crazy to music, and then sports. And I'm
Who do you like?
so I'm by the way, I was thinking about it today. The Orioles, the Dolphins, and the Devils, which is kind of odd.
Excuse
actually.
me?
When I think about it, Orioles, Dolphins, it's kind of odd.
How did that
It's
happen?
all different. Since a little kid, I'm a big Orioles fan. I've gotten involved in the
Cal
team.
Ripken Jr.?
He was
Is
my
that-
hero. My
okay.
daughter's named Callie. So
all
the
right, got
so I'm
that.
a
What do we think of
crazy-
Hawk Tua?
What's
You like
that?
Tua?
I do. I think he's
He's
good.
okay.
He's not great.
Okay, he's not great.
He's not great. And then so I because I live in Florida some of the year.
Oh, so I got it now. Your era is like Dan Marino, Cal Ripken Jr.
Yeah.
What was the other team? Devils.
The Devils.
That one I
Martin
can't-
Brodeur?
Yeah. So
Okay.
he's a friend of mine.
What?
Okay.
So yeah.
Oh, look at that.
Yeah. So no, I'm pretty maniacal about. So that's my whole life. Like
Okay.
I'm not. I don't spend a lot of time in art museums. So I got a pretty simple
Rick,
life.
will you come back on?
Yeah. No, this is awesome. I still can't believe.
What are you
I
doing
was-
tomorrow?
I'm in here. If you're
so we're
around.
gonna ask you a final question that I'd love to get your answer to, and but before I ask it, I have a gift for you. Can I give you a gift?
Yeah.
Okay.
Oh, it's awesome. I didn't think that was getting a gift from coming.
This is for you.
Oh,
This
thank
is
you.
Look, we know your schedule is insane. Please, you can open it.
Okay.
We know your schedule is insane, and we know you have a lot of people to see when you're out and about. We just wanted to say thank you so much for spending this time with us.
He can't get
And,
in.
it's a trick.
Is it
No.
literally a trick?
Do we have a way to help him?
Is there a scissors or something that'll allow me to?
It's a trap.
By the way, this is sort of explains my life. Like I can't screw in a light bulb, but I'm pretty good at
Hey
understanding
guys,
companies.
he's a bond manager. Get him something to cut this.
Oh,
with.
hold on. I think I got it.
All right.
I think I've severed it somehow.
So that's
Dude.
we could. You may not be a bond king, but we
Yeah.
consider you to be peerless. That
Peerless.
is the peerless bourbon.
I like it.
All right.
Thank you so
bourbon
much.
Guy?
Very kind.
Are you a bourbon guy?
I am more tequila, but
More tequila, same with
yes,
me.
yes.
Oh, you're gonna drink bourbon later.
There you go.
What is the thing you are most looking forward to?
In markets or in
That's our parting question. You can answer it any way you want to. Markets,
honestly,
life.
the end of the year. I mean, this has
Okay.
been. I'm exhausted.
Oh,
Like,
I feel
this
the
is-
same way.
I just want to get to. the.
How many Christmas
week.
parties do you have to go to in the next
I'm
week?
going. So I'm hosting one tonight, and
Okay.
and a few more, and then and I don't know. The idea of playing golf and just relaxing for a week will be great.
You're going to take a week off at the end of the year?
That's all. Yeah, that's my visibility is beyond.
I'm going to do the
that.
same thing.
Yeah, that'll be good.
All right, I think we're all feeling it this time of year. Ladies and gentlemen, Mr. Rick Rieder.
Thanks, Roger.
Thank you so much for coming. Guys, please, if you enjoyed the show, please follow Rick Rieder and BlackRock's excellent commentary everywhere. Rick is on LinkedIn, @Rick Rieder. He's on Twitter, @Rick Rieder. Very easy to do. Thank you so much to Rick. Thank you to BlackRock. Great job this week, everybody. John, Duncan, Rob, Chart Kid, Matt. Great job, Sean, Nicole, Daniel, all the people that help us put together, Sean, all the people that help us put together the show. We appreciate you. And thank you all, Compound listeners. Thank you, Rick Rieder. We'll talk to you soon.
Thank you.